Hey everyone, welcome to the Juniper Links accounting channel. My name is Caroline and we're going to talk about the advantages of a limited company. So the first thing I want to talk about is legal separation. And what this means is when you incorporate a limited company, it becomes its own legal entity. And this is completely separate from yourself as an individual. So it'll have its own money and its own assets. So for example, if it buys computer equipment, that equipment belongs to the company, not you personally. And you, as the director, have a limited liability for its debts. And this is normally the £1 share that you open the company with. This means, for example, if another business was unhappy with something that you did, or they were trying to come after you for money because of a business issue, or a trading issue, then that company can only go after your limited company's assets and money because it has no right to come after you personally for any kind of claim they want to set against you. So this is the big difference when you think about a sole trader, because the sole trader is exactly the same as the business. So you are the business. There's no distinguishment there. You're exactly the same. So this means all of the debts that your business may rack up over the years, or if it gets into any legal trouble with another company, then all of that affects your personal finances as well, because there's no separation between your business and yourself. So they can come after your house, they can come after the equipment that you have. This is where the limited company is very useful, because the most you would lose is your £1 share and also any loans that you provided the company to get it started and to start paying for some of the initial startup costs of getting everything ready. So if you did have that loan that you lent the company and the company never made the money to pay you back for that, then that's gone as well, in addition to your £1 share. But that's all that can happen. Unless there's one stipulation here that you have to be careful about. If it is found that the director was acting negligently or committing some kind of fraud, then HMRC could come after you personally for everything, basically. So there would be unlimited personal liability in that case. So if you were purposely taking out dividends when the company had no profit to pay you those dividends, which resulted in the company not being able to pay its corporation tax or VAT, then you would be personally liable for those taxes because it was your fault that the company didn't have the money to pay it in the first place. Okay, so the other point I wanted to make is that a company is tax efficient and flexible. So as a director and a shareholder, you're entitled to both salary and dividends. So these are two different forms of income, personal income, and salary is probably what you're most familiar with. It's taxed through PAYE, and normally you'd run a small salary and then take the rest of the company's profit as dividends, depending on how much you want to take during the particular tax year we're talking about. And normally it makes sense to do it up to the higher rate tax threshold. You can choose how much salary to pay yourself during a year, whichever one makes the most sense in terms of looking at the employee's NI threshold and the employer's NI threshold, and also the personal allowance for every year. And a good accountant will help you do this. So for example, this year it will be £9,500 for the year as salary. And then dividends have relatively low tax, so it's 7.5% in the lower rate threshold. And for this year, that is £50,000 income in total. So this would include salary and dividends and anything else you had earned, like for example, property income, self-employed income. So this is the cap for the lower rate tax threshold this year. And another benefit is that you can actually choose how many dividends you want to take each year. So you don't actually have to take out all of the money from your company. If you leave the money in your company, then that income, your company's income, stays as your company's income, and it'll just be carried forward to the next year. You can use it on expenses, or you can find alternative ways to benefit from that. For example, your company can pay into a private pension scheme on your behalf and get tax relief for those payments. Another advantage of a limited company is that it legitimizes your business. So from a client's perspective, a limited company appears more credible. So you're taking your business more seriously, and you've actually bothered incorporating a business to give it legal protection, its own name that no one else can use as well. And often larger businesses would only want to work with other limited companies. So if you're contracting, if you're freelancing, and it's a larger company, they'll want to work with you if you're a limited company. If you're a sole trader, they may not be as inclined to do so. So having the company can also open up new opportunities and also higher paid work compared to having just a sole trader set up. So when you incorporate a company, it has to be registered on Companies House, and it cannot be similar to another incorporated body. This means that your company name has some basic level of protection once you incorporate it. As a sole trader, it's just a trading name. Anyone else could use it if they really wanted to. And you can, of course, take them into legal disputes about that name and how they've basically stolen it from you and it's actually your company's name. But, a pretty easy way to protect that name is by registering a company through Companies House, and that will at least prevent any other incorporated company to have the same name. Of course, if you accidentally register a company name that is also a trademark for another business and they decide to challenge you on that, then you could have some problems there. But in most cases, they would have already registered that company name anyway. So just do your own research on the company name just in case. But yes, when you actually open a company in the UK, it'll be protected. So no other UK company can have the same name. A common misconception is that a company is really difficult to open. And fortunately, in the UK, it is not. So I know in the EU, there's lots of weird rules, lots of bureaucracy involved and legislation that you have to follow. And also, usually it's quite expensive. So we're very lucky here that opening a company is quite straightforward and it's all done online. Companies House will usually get the documents back to you within 24 hours. There is a £10 filing fee for the online submission, which is not that big of a deal. And then once you get those documents back, you can set up a business bank account for the company and you're basically done. You can start trading. That's it. However, the downside is that there are more legal filings involved, so we do usually recommend having an accountant when you do start trading. And we do actually have an accountancy service, and it's mostly for those who are contracting through their company. So for example, an IT consultant, project management, those sorts of things where you're providing a service in exchange for a fee. And also we can help those who are content creators and freelancing through their own business. So if you do need help with your accounting requirements, then feel free to reach out to us at hello@juniperlinks.com. But yes, to initially open the company, it's extremely straightforward and it's very quick, especially if you use an incorporation service. They can kind of help you navigate some of the more difficult questions, like are you a person of significant control and those sorts of things. But as part of our service, the incorporation is included in our monthly fee, so there's nothing extra to pay. The next advantage to having a limited company is that it is easier to sell or transfer the ownership to someone else. So all of the assets in the business are owned by your company. So they're not anything to do with you personally. You can essentially create a complete package to sell in one go. So you can just add up all of the assets, add up all of the cash, calculate the value of the business, and then you can sell it off or transfer it to someone else as just the one singular thing. Unfortunately, as a sole trader, it becomes much more complicated and tedious to work out what the business assets are, what the personal assets are. They are all jumbled together. There's no real separation there, so you're gonna have a fun time working that out, basically. Okay, this is an interesting one. So the entrepreneur's relief has been changed to something called business asset disposal relief. So I don't know why they made it longer, but it's essentially the same as entrepreneur's relief, which is what it was called before the 6th of April 2020. And basically what this lets you do is just pay 10% capital gains tax on all qualifying assets during the year. So this includes if you sell assets, it also includes if you dispose of your business. without the relief, you would be looking at 10% tax in the lower rate threshold, so up to the £50,000 income, and more than likely you're probably already reaching that threshold if you have been doing well. Then that means all of the capital gains you get after the initial tax-free allowance for the year would be taxed at 20%. So this is not ideal, especially if you've got a very high amount of money to get rid of at the end of the year when you're trying to close the company down. The stipulation to actually claim this relief is that the company must be trading for at least 2 years, and it has to be a trading activity, so it can't just be holding money, for example. And it's the most useful with a large amount of reserves. So like I said, if you've got, let's say, £300,000 left over in the business account after taxes, this is profit after tax that's been carried forward, and it's a total balance of 300,000 that's just spare money in the company, and you get to distribute that as a capital gain once you close it down or dispose of it. Basically, this means you can pay 10% tax on this amount here after the initial tax-free allowance, which is recently around £12,000. So that's a lot more attractive than having to pay 20% on the whole thing. Obviously, that's double the tax. So this is where it becomes super helpful. And yes, the company does have to be trading for at least 2 years. If it's just trading for 1 year and you decide to close it down, then you cannot claim the entrepreneur's relief or the business asset disposal relief. This is also available to sole traders, so it's not just exclusively to companies. But of course, it's a lot easier to work out exactly what the assets are in a limited company than a sole trader because it's so mixed together. And there are ways to do it where you can separate them out pretty well. You'll just kind of follow how company accounts are done for limited companies more than just like your sole trader tax return where you're just like, yep, got these expenses and that's the income. There you go. So those are some of the advantages of having a limited company. I hope this video was helpful to you guys. As always, if you have any questions, feel free to comment down below. I would also be super grateful if you could hit that like button just to let me know that the video was indeed useful. And also, if you're interested in more content like this, then you can subscribe and click the notification bell so you know every time we upload a new video. Thanks so much for watching, and I hope you guys have an amazing day.